I'll be showing you guys everything you need to fully understand the turtle soup model as a whole, and I will also be leaving you guys off with action that you can use to implement into your next trade using this exact concept. Throughout this entire video, you'll be learning the mindset required to trade this model profitably, the entries that you'll be looking to get into. The most important thing that I want to be leaving off with you guys is especially the secret to validating your turtle soup models. Now, the main thing to fully understand about a turtle soup is that it is a stop hunt of highs and lows. Now, as you can see in this example right here, the main fractal point of a turtle soup is once it takes out a major liquidation point, and that is when we see the oncoming reversal to the intended direction. This model happens on both higher time frame and lower time frame. It is a fractal model. Now, as you can see, once price takes out this major liquidation point, it has now accumulated stop losses that it is now using to fuel its next move. And that is why when you probably go into a position where you've entered and you put your stop loss below a specific low, and price then seamlessly comes to your stop loss, stops you out by a wick, and then goes to your TP. Usually with the model I'm showing you guys, you want to have at least two turtle soups occurring, one on the higher time frame and then one also on the lower time frame. These are the main models of turtle soup, the first one being the most high probable. However, for that increased probability, it sacrifices its risk reward ratio. With this model, you can only expect about a 1-2 or a 1-3 at best. With this model, it is simply following the trend. If the trend is bullish, you'll be looking for a turtle soup of any short-term lows. Once that happens, you'll enter with the increased volatility, targeting your drawn liquidity. Now, the counter trend model is a very risky one. However, it should be used in very critiqued situations, okay? When what happens with this one is that once price usually takes out a high, for instance, in a bullish market, you'd expect that we'll then see a retracement, and the retracement is where you'd be looking to enter. Once price makes that retracement, takes out a low, you just take your profit right over there, and then price will continue in the intended direction. The reversal setup requires a lot more patience because it doesn't happen as often as a continuation pattern that just follows the trend, and it also has a low probability. However, the increased risk to reward ratio is there. So as you can see right here, it will mostly take out any liquidity that is being positioned in either the highs or the lows. However, remember, this is low probability, however, higher risk reward ratio. Now, here's a simple chart example showing you how all these models work in unison. This is the third model right here, the reversal setup. As you can see, price goes from a heavily bearish market. We start seeing the slowdown of volatility and bearishness. And then here we get our last kiss, which is the liquidation of these equal lows. And then we see major volatility to the upside, okay? That is the first turtle swoop. The second one is now with the new bullish trend. As you can see, you're creating short-term highs and most importantly, the short-term lows. All these lows act as liquidity for our turtle swoop. And then we get a major impulse taken out this short-term low right over there at the major low, just wicking below, guys. Especially these wicks, it's signifying to you guys that this is a turtle swoop. And it's also one of the ways that you can differentiate between a change of character or a market structure shift over a liquidation. As you can see right there, increased volatility once again. Now, here is our second model, which is the counter trend model. We are heavily within a bullish trend. However, as we know, once price breaks a high, we can expect a retracement, and this is where you'll be looking to enter in, targeting any of the short-term lows as they too also be liquidated, okay? However, remember guys, this one is very risky, so I'd only use it in very primed conditions. This is the most important point. I want you guys to fully focus on this. The type of liquidity that you guys want to be focusing on is wick rejections, okay guys? As you can see right here, price makes this wick point and then gets liquidated. Price makes yet another wick point and it gets liquidated. Another wick point and it gets wicked above, so it was liquidated. All of these wicks act as liquidity that price will be drawn to, okay? Wicks created by news are also very highly volatile to be taken out later on the market. So I want you guys to be using this as your drawn liquidity as well as your points of turtle soups, okay? As you can see right here, price wicks above there. That's your turtle soup model, and then you look to actually enter within the increased volatility, targeting the drawn liquidity, which is the next wick rejection point, okay guys? Now, yeah, the other types of liquidity, this is just sort of also categorizations of different liquidities. So first thing will be your drawn liquidity, which would be your main target, your internal range liquidity, which you'll be using for your turtle swoop model. As you can see right here, price takes out the liquidity created within this main range, okay? Same thing as short-term lows. And then your external range liquidity will be liquidity created within a previous trend. Say for instance, this was a bearish trend just before this, okay? Price makes this wick high, goes down aggressively, okay? And then price makes a major turtle swoop here. Now having this reversal setup occurring, and this now acts as our internal range liquidity, which we can also target. However, this liquidity, okay, is less probable than price actually reaching the most recent drawn liquidity. So I'd actually just take partial out at this position, then let the rest run to the internal range liquidity. Here's another example of this. Price is going in this uptrend right here, and you can see it creates highs high lows and high highs. Now this low that was creating this option acts as our internal range liquidity, our main uptrend range. And this acts as the most recent drawn liquidity. As price makes this major retracement, turtle swoops this internal range liquidity. We then start to enter when increased volatility enters, and then we target the internal range liquidity, looking for, as I said, for a 1 to 2 or 1 to 3. This is the example on, for instance, on EURUSD and GBUSD. EURUSD will create a turtle swoop of the highs. However, GBUSD does not create a turtle swoop of the highs. Instead, keeps the high protected instead of breaking it. And then this divergence, this difference in market structure, we can use our advantage to understand that now we're having input by large institutions, which we can now be a part of. We can also use this both on NQ and ES, NASDAQ and the S&P 500. As you can see right here, NASDAQ's creating highs and lows, and then it respects this low point. Okay, however, on ES, we see that this low point gets liquidated, and that shows us that we have just made this turtle swoop model where we can now be quick on the trigger, understand this is a high probability turtle swoop, and now look to target the most recent drawn liquidity with this added confirmation of the SMT divergence. This is also another conference I also use a lot of the time, especially trading the turtle swoop model. It is the dynamic trendline liquidity, where price creates a 3-touch trendline or a multi-touch trendline. And this trendline, as you understand that as it keeps on getting stronger and stronger, it is building more and more liquidity. So our goal is to look for price to at least break one of the lows, okay, or if it's a bearish trend, one of the highs that are being part of this trendline liquidity, okay, because then we can understand that it is actually liquidating any people that have entered off of this reaction, looking to target high and placing their stop losses at the low. Price come, we reject that point, we see this as a turtle swoop model, and then we target higher, okay. So this works very good in confluence with the continuation model right here. Same chart example right here. Price creating all these wick rejections. Also, yet another very important point, guys. As I said, the wick rejections are major liquidation points. And this is right here. Wick reject, wick reject, wick reject, 3-touch trend line. What does price do? Comes to the most recent low that was part of that trend line, sweeps it out completely, and then pushes to the drawn liquidity. Now that we have a very good understanding on the actual turtle swoop model and the validations to use for it, you also have to understand the basic time frame combinations that you guys want to be using. A very good one for swing traders would be the daily and the 4-hour. For intraday traders, it would be the 4-hour and the 50-minute. And for our refined scalpers, it would be the 1-hour and the 5-minute. Now, this is an entry model that I use majority of the time when trading this model. It is the market structure shift with the lower time frame turtle swoop. I say, guys, you want to be looking for a higher time frame turtle swoop and a lower time frame turtle swoop. Right here, as you can see, price makes this turtle swoop, starting off this reversal, and then we enter the continuation pattern, turtle swoop model. Price liquidates that low, and ideally you want it to also be tapping into some sort of fair value gap or order block, but if it doesn't, that's completely fine. And remember, our main focus is the liquidations, okay? Once you start to see that price is showing us that new volatility and start to impulse to the upside, that's when you look to enter and targeting the drawn liquidity. Even if you're looking to have a higher target, you can target the external range liquidity, like this example. Now, how often does this model actually occur? It occurs every single day, every session, London, New York, Asia, and on any pair, guys. Why? Because all pairs experience manipulations and liquidations. And now that you have this understanding of the turtle swoop model, which is based off of liquidations, you can now be a part of new trades. You guys can also implement this. This is sort of like a basic trading plan that you can use for this. The one that I use is the 4-hour or the 1 hour and 5-minute time. The best pairs to trade this on is on USD and GPSD, as well as NASDAQ and SP 500. Why? Because it allows the use of the SMT divergence. And if you do trade Asia, USD JPY is also a very good pair. Now, risking 1% would be the baseline for risk reward ratio range from 2R to 5R, depending on which model you're trading off of. If you're trading off of the continuation, a 2R to 3R is very good. And if you're trading off of the reversal model, and then 4 to 5R would be very good also for your boundaries. And another thing, guys, the best time to trade this would be after news, guys, because what does news create? It creates these major wicks, which leave us that major wick liquidation, which we can use for our turtle swoop models. Any model alone is very good, but if you want to add even more confidence to this, I would recommend that you use a combination of the power of 3 and the candle range theory, which I'll be making more videos on, guys. Now I'll be finally imparting with you guys the mindset required to trade this model. You have to become the turtle. Now put up a picture of your master Uwe, because he just really represents this very well. His tranquil and calm state is what I would like all of us traders to also implement into our trading days. 2 trades a day would be a maximum. With our risk management, this should allow us to be profitable long term. Now, not every day has to be a trading day. Your goal is to think of the next 10 trades and not this one trade. The outcome of one trade is insignificant to the next 100 or even thousands of trades in your trading career. And as always, guys, it's always very important to understand that wins and losses cannot exist without one another. If you're not willing to take a loss, you cannot look to take a win. The last point I want to give to you guys is that trading is simply minimal risk exposure and probability. Once you understand that, that can avoid any hesitation or any complications that you are putting forward to yourself. I hope you guys fully now understand this concept, and all these slides and notes will be posted in my Discord link on my website, guys. If you need more understanding on how to now apply this and pairing it with your auto blocks and favor leggers to give them much more probability, you should watch this video where I talk about the mountain and peak model, which is very similar to the turtle soup model. And from that, guys, mostly this is real trading.